Good morning. I hope you're all very well and surviving winter. At least we've had some good news in the markets. Markets up 10% from their mid-month lows, ending the month at a strong point, which is great. And also a great data point out of the US last night. The US entered a technical recession. I'm going to explain later why that is good news and not bad news. As usual, there'll be a lot of hand waving, but it is good news coming out of the US and certainly gives us some more comfort going forward. The Fed is not going to drive us into a recession anytime too soon. After the market update at the end of the presentation, I'm going to take you through the 4 Ds that are constraining global growth and where to hide in such a low growth, low return environment. But looking at July 2022, asset classes in review, you can see a good month despite the huge pullback at the start of the month, looking very strong at the end of the month, with world equities up nearly 7%, South African equities up 4%, Japanese equities up 9%. Some of the asset classes that have been hurting during the recession and high inflation and high interest rates, such as 4th and FANG having fantastic months, bouncing back nearly 10% returns. Gold giving up its returns, down -2%. And the only asset class having a tough month being China, but as it was up 16% last month, to give back a little bit was expected. And we're still very confident that things are looking good, very good in China. But I'll talk more about that as I do later on. And it was great to have such a strong month, because the world seemed to deteriorate quite quickly during the month. Not only did we hit new lows in equity markets at the beginning of the month, but we had Boris Johnson's resignation. We had the terrible assassination of Shinzo Abe in Japan, Japan's former prime minister, longest standing prime minister. And we've also had Mario Draghi, the Italian prime minister, resign. Flash PMIs deteriorated in July, forecasting recession. Consumer confidence plummeted globally. So there was a lot of things to be worried about. And it was one of the reasons why markets were down so much mid-month. But they also have bounced back very strongly, and there are a lot of good reasons why they bounced back. And I'll talk about those as we go through each of the underlying regions. Looking at the Sygnia funds, as I mentioned, some of the hardest hit funds in a rising inflation environment, like US tech, bouncing back. So the best performing fund for the month is the Sygnia ITRIX 4th fund, which is great to see, up 11% for the month. It's an awesome month and a nice bounce in 4IR. It's not dead. There's still a lot of life there. South African listed property up 10% for the month, which is also great after a very, very poor start to the month. Berkshire Hathaway having a good month, as well as the US. Looking over a 12-month period, it's still value, which is leading, with Berkshire as a proxy for global value doing well, and the Sygnia Divi Fund as a proxy for local value doing well. And then coming in third place, the Skeleton Woodbine Flexible Fund, also having a decent return of 11% over the last 12 months. But generally still very much a value environment, with growth shares bouncing back for the month as inflation concerns come off slightly. So it's all about whether we are in a recession, whether we aren't in a recession. If we are in a recession, how deep is it going to be, or how shallow is it going to be? And everybody seems to have a different view, and every indicator seems to have a different view. At the first week of the month of July, markets were down to new lows year to date. And you can see that this chart was done the first week of July, and we had small caps in emerging market stocks down just over 30%, which is in line with the median fall for the recessions over the last 50 years. So certainly a lot of risk was being priced in, risk assuming that an average recession was in place, and there just aren't the imbalances that were in place during previous recessions. So to price in an average recession, I think is way too pessimistic. Developed markets and the S&P weren't pricing in as much downside, down 23% at the lows, and they've also recovered quite nicely for the month. But at this point in time anyway, equity markets are pricing in a recession. quite a deep recession for EM and small cap stocks, shallow recession for DEM and the US. Right now, the markets have recovered slightly, but the bond market is still pricing in a recession. The yield curve, the 10-year, 2-year yield curve is inverted. At the same time, the leading economic indicator, which I spoke about last month, was at 3% last month. It has fallen slightly down to 1.4%, but it's still positive, which means it's not seeing a recession anytime soon. And if there is, it'll be a very shallow recession. At the same time, fund managers are the most pessimistic they've been since 2001. That's on a global basis. On a global basis, according to the Bank of America Merrill Lynch survey, fund managers have the highest cash levels since 2001. So a lot of risk is being priced in. A lot of people are very pessimistic. There are signals saying that we are in for a recession. If you look at equity markets and bond markets, the LEI is still saying we're not in a recession. There's still a lot of risk, and I'm going to talk about the risk later on, but a lot of it's also being priced in. So we maintain our defensive position, but we maintain an overweight equity position. We have taken some profits, a small amount of profits, after global stocks bounced 10%. We did use that fall in the early July to top up our equity position, and we subsequently sold out of that, just trying to take advantage of the volatility. And I think volatility is going to be with us for quite some time. So looking at the US, it's all about the US, and that's why I'm going to bring out my hand waving. So the US raised rates by 75 basis points for the second time in a row, quite a historic raise, 1.5%, which is in 2 months. That's certainly a very, very, very big increase. And then last night, the US came out with its second quarter GDP numbers, minus 0.9%. And as you're all well aware, the US in the first quarter was also negative. So that means 2 consecutive negative quarters of growth, GDP growth in the US, which means technically it's in a recession. So the hand waving that comes out is well, yes, it is technically in recession, but first of all, it's the first print of the second quarter GDP, and the final number will only be out on the 29th of September, and that includes a lot more. So it might not be in a technical recession. The other hand waving is that the Bureau of Economic Research in the States, NBER, they don't just look at GDP growth when it comes to actually defining a recession. So even if the second print of September is negative, it doesn't mean it'll be a recession. But more importantly, the labor market is still strong and consumption is still strong, and most of the pullback in the GDP was as a result of inventory changes. So that's why the hand waving, there's a lot of technical issues. But why is it good news? It's very, very good news because inflation doesn't cause recessions. Inflation has a lot of impacts, but it doesn't cause recessions. Raising interest rates, central banks raising interest rates to squash growth, to curtail demand, to try and bring inflation down, that's what causes recessions. And the big question is, does the Fed have to raise rates enough to push the economy into recession to control inflation? That's something we don't know. But if the US is already in recession, even if it's a shallow one, even if it's a technical one, it means that the Fed has already achieved half its goal without even trying. It means that demand side growth is certainly not as strong as the Fed was expecting. And it means that the Fed is unlikely to push interest rates a lot higher or much higher than was expected. Why is this good news? Well, because although the Fed uses interest rates to control its economy, the rest of the world bases their interest rates and their currencies on the strength of the dollar and US interest rates. So while the Fed has to look after itself, if the US is very strong, the Fed has to raise interest rates, which then ultimately push the rest of the world into recession, which then slows down the US. It's a very convoluted and slow process, and everyone else gets hurt. But if the US is already not that strong, if it's not growing that strongly, the rest of the world is already actually growing faster than the US. Well, then that's great news. It means the dollar is going to be weak. It means the rest of the world doesn't have to get pushed into recession for the US interest rates, for US inflation to be tamed. So that's why it is good news. And certainly we are already seeing a lot of what the Fed's first 75 basis point rate hike having its impact. Since since March and April peaks, we've seen gold down 17%, metal prices down 30%, oil down 20%. We've had long-term inflation expectations from consumers, and that's obviously very important. The Fed worries about consumer inflation expectations, and that's fallen to 2.8%, which is great. Another thing for the Fed not to worry about. Core inflation remains below its March peak. So even though we saw in July the highest inflation in the US since 1981 of 9.1%, and that's what caused markets to plummet so quickly in the first week of July. Even though we've had that number, certainly inflation has now peaked. Inflation is a backward-looking number. All the forward-looking numbers are showing that inflation has peaked, has rolled over, and I think that's what's giving the market some sense of relief, and that's why markets have rallied 10%, because the Fed has achieved its gains to a large extent. The chart on the right shows further interest rate hikes that the market is expecting. So the US FOMC says that they're going to raise rates to 3.4% by the end of the year, and then 3.8% by the end of 2023, so an extra 40 basis points next year. Markets think that that's not the case. They think we're going to have roughly, if you look at this chart, says here 55, but that's just obviously an average, so roughly 50 basis point hike in September, and then a 25 basis point hike in October, and another 25 basis point hike in December. But then next year, the market's already pricing in cuts, saying that the Fed has already achieved what it needs to have. Yes, they may need to push rates high, but if they do actually push rates up to 3.4% by the end of the year, they're going to have to start cutting them very quickly next year. So then there's some question of, well, will the Fed look through that? And if they're seeing that the US is already in recession, if they're seeing that 10-year curve is inverted, then that might actually be the case. Regardless, the US economy is not as soft as the technical recession implies. But regardless, it's unlikely the Fed is going to surprise the upside in terms of how much hiking they have to do. The Fed is already above markets. So if anything, the markets need to adjust upwards, or the Fed needs to adjust downwards. But it's highly unlikely the Fed has to adjust upwards, which means that we are unlikely to have any negative surprises coming through from the Fed. That said, it's still going to be highly volatile time. And I really, although I do think that the next 6 months are looking positive, because the Fed isn't going to have to surprise to the upside. Next year's another story. So right now, inflation's at 9.1%. There's an easy path down to 4% for inflation over the next 12 months because of COVID and supply disruptions ending. But towards the middle of next year, when inflation is down from 9% to 4%, the Fed's going to start worrying about how to get down to 2%. And that last little bit is going to be a bit stickier. And maybe towards about 12 months' time, Fed starts raising rates again. So the path is not clear. There's still going to be a lot of volatility. But right now, we think that things aren't as bad as they look. We're still very much in our base case medium road scenario, where the Fed only hikes as much as they forecast for the rest of the year, and as a result, stocks can recover slightly more. Yes, stocks are up nicely from their lows, but we think the stocks can recover a bit more the next 6 months. But then 12 months out, there could be a bit more downside. So bit of a sideways volatile moving market until we get clearly through the inflation scenario, and also their risks. So our base case doesn't expect any more acceleration in the European energy crisis. And I'll talk more about that later. But assuming no more acceleration there, we could have a decent next 6 months. The other thing that's going to help the world economy survive and not go into a global recession, even as Europe does go into recession and the US is now in a technical recession, is China. China is about 18 months ahead of the curve. They effectively were in a recession, driven by their property bubble being bursting, and because of the tech regulations they put on, which slowed growth, and their zero tolerance COVID policy. Those are all in the past. The government continues to stimulate and continues to drive growth. Growth is recovering very nicely, and we think this will help the world recover as well. So the top chart just shows total social financing, which is basically credit in China. that continues to bounce very nicely, which means that GDP will follow and be strong. And not only is that already recovering, but there was more positive stimulus this month from China, with the Chinese Ministry of Finance suggesting that they're going to allow an additional $220 billion of special government bonds in the second half. That's 40% higher than the budget. So that each month for the last 4 months, China continues to surprise to the upside with more and more stimulus. I've been a China bull for quite some time, but even I'm surprised by the amount of stimulus that's coming out. It really is incredible. We're now looking at 7 trillion yuan or renminbi of money that's going to be thrown at infrastructure projects and other fiscal support. So, a lot of support coming through from China. Now, the question about emerging markets is a little bit less clear. As I've said before, emerging markets will benefit from petrodollars being recycled and from China's strength, but emerging markets do get hurt by a strong dollar, and the dollar is incredibly strong. And the dollar is the strongest it's been against the pound since 1984. It had parity for the first time since 2002 against the euro before recovering a bit. So the dollar is incredibly strong, which is tough on emerging markets. But we do think the dollar is going to weaken slightly, or at least not strengthen. And the chart on the bottom right shows emerging market real money supply growth has outpaced developed market real money supply growth. Money supply growth tends to lead markets. So you can see the blue line is emerging market money supply relative to developed markets, while the black line is emerging markets. Stock prices relative to DM, and that's certainly lagging a bit. And we do think that all the stimulus that we're seeing and the strong money supply growth will help emerging markets bounce over the next 6 months. So we continue being overweight China and emerging markets. Let's look at the big risk factor, which hasn't gone away. There hasn't been much change in what's happening with Russia and Ukraine. Certainly not from an energy standpoint. The big concern is natural gas flows. And we did see that Nord Stream 1, which is a big natural gas pipeline from Russia to Germany, that was stopped for technical factors from the 11th of July to the 21st of July. It has subsequently restarted, but only at 40% of capacity. And now it's actually down to 20% of capacity. So certainly there are some risks there. And what is allowing the potential for Russia to weaponize its natural gas is the fact that the IEA say that Russian oil export volumes have only fallen 5% since January. So despite all the sanctions and the fact that oil prices have doubled, oil volumes are only down 5%. That's quite incredible. Yes, oil is an elastic demand, but with all the strategic reserves that were released, the huge amounts of reserves that were sitting in tankers because oil prices were so low, you wouldn't think that a 5% fall in volumes would have had such a massive impact on prices. Unless speculators got involved, and there could be a lot of speculation that's happening, and markets do forward look, so maybe that's what's driving it, is people investing in oil. But the fact that it's only a 5% fall in terms of Russian oil exports, and the fact that the oil prices have more than doubled, means that Russia has seen its current account surplus widen to a record $70 billion in Q2, the widest it's had since 1994. So Russia is sitting there rubbing their hands with glee because they're still exporting oil and natural gas. The prices have skyrocketed, and sanctions are having the inverse impact. Sanctions aren't hurting Russia. Sanctions are just pushing the prices up, which is giving them a great dollar revenue from the exports. And that's giving them a huge war chest, which they can put towards the war. But also it means that they can probably curtail some of those volumes because they're now building up cash reserves. So the chart on the right just shows flows of Russian natural gas to Europe, which you can see have plummeted in June, and then further slowed in July because of the turn-off of Nord Stream 1. And it could be very easy for Russia to weaponize that and further slow down the natural gas, which would push Europe into an even deeper recession. So that's certainly a risk. It's not our base case scenario, and the reason why it's not a base case scenario is that things aren't looking that one-sided. That they are still. Russia did turn back Nord Stream 1 on, and even though flows are lower than they were before, there still are flows flowing through. More importantly, Russia and Ukraine signed a UN-backed agreement that will enable Ukraine to start exporting its grains, and will allow Russia to resume exporting its grains. Now, together, Russia and Ukraine account for nearly 30% of global wheat exports. So that's very positive for global food inflation. So we certainly think that will see the peak of global food inflation. And the fact that agreement is in place and those wheat exports have started, and the fact that natural gas is flowing again, means that a pure 100% cutoff of natural gas is unlikely and doesn't filter into our base case, but it is a risk. So as I've said, some positive things coming through in terms of the US being in a technical recession, so the Fed doesn't have to raise rates as much as before. Metal prices falling, which is also good for commodity prices in general are falling, which is good for inflation, and it will allow inflation to fall quite quickly, at least in the short term. Consumer expectations have fallen, so altogether central banks shouldn't be forced to panic and hike rates too quickly. Things are looking more balanced in Russia and the Ukraine, and China is still looking very positive. So overall, we think that we are positive in the outlook for the next 6 months globally. South Africa, there always are things that are quite shocking. And this month we had Thabo Mbeki come out and warn about South Africa heading straight for an Arab Spring, which is a terrifying statement. The former president was saying that due to a lack of service delivery, there's likely to be further unrest. And there's no end in sight for the lack of service delivery, because there's still not an agreed national plan to address these challenges. And by that, President Mbeki was referring to the social compact that Ramaphosa promised to have within 100 days of SONA, the State of the Nation address in February, and that didn't come out. Subsequently to Mbeki's statement, Ramaphosa did release a framework about a social impact compact, but still no details on that. And that's what it boils down really when it comes to South Africa, which we keep saying. No reforms, no investment, and no reforms means no power and no ability to export. So we're seeing Transnet, their 2021 freight volumes were down 24% relative to 2004. So over the last 17 years, freight volumes have fallen 24%. Not a great success story. And those have all been moved onto the roads. And SANROL has said that our roads are in the worst state they've been in the last 40 years. There's a lot of money, but they just can't get the tenders approved. And so roads are looking worse and worse and worse, and rail not helping in terms of freight volumes. Eskom 2022 annualized load shedding is double the worst level of load shedding since inception in 2007. So that's also all-time highs in terms of how bad things are getting. And as a result, we get the chart on the right, which is South Africa fixed capital formation. That's how much government and the private sector are prepared to invest in South Africa, whether it's starting businesses, building plants, building factories, building houses, whatever it may be. That's at a low of 13.7% compared to a target of 30%. So that's way off, and that's why there are no jobs being created. To create jobs, we need investment. To have investment, we need power and working rail lines. To do that, we need reforms. And yes, President Ramaphosa did come out this week with some fantastic ideas to fix the load shedding problem, but we've heard so many fantastic ideas in the past and so many promises, and South Africa certainly doesn't lack in terms of knowing what needs to be done. We've got fantastic ideas. We know exactly what needs to be done. We say all the right things. It's just actual execution that's the problem. So I'm not holding my breath. But if we do get what needs to happen over the next 12 months, as is promised, it could be very, very, very positive for our country. So, I hope, but we remain underweight South African equities until we see some follow through on those promises. At the same time, we had high energy prices, drive inflation to a 13-year high in South Africa, 7.4%, which was shocking. However, not a cause for concern. Already we've got oil prices rolling over and the rand is strengthening quite nicely. We're down at 16.5 today from our peak of 17.5. That will help inflation as well. But more importantly, core inflation remains muted. Core inflation is at 4.4%. That's below the SARB midpoint of 4.5%. And with growth being so low in South Africa, we don't think there's going to be enough demand-driven inflation to take core inflation out of the band. So we think that the SARB doesn't have to push rates too high. They are certainly becoming or remaining ahead of the curve, having raised rates 75 basis points from 4.75% to 5.5%. But I think that from here on, they are ahead of the pack, and they won't need to raise as much as they expect they will. So they are expecting to have to raise rates to 8%. I don't think either inflation or growth allows such a high number of increases. But it is already filtering through. We are seeing some nice returns. Our enhanced income fund is now up to a yield of 8%, like slightly over 8%. So that is great for income assets and credit assets. So we are happy about that. But we don't think it's going to go as high as expected. So we remain overweight South African bonds. Like South African bonds are looking incredibly attractive with yields at 11%. That's worst case scenario, not worst case scenario, but assuming that yields don't weaken, that's nearly 1% a month, which is a very attractive return. And assuming that yields can rally 1%, well, then you're looking at nearly a 20% return. So with quite low volatility, that's looking like a decent return. So we remain overweight South African bonds. We remain underweight South African equities. As I've said before, energy risks remain, but barring that an escalation in terms of what's happening in Russia and Ukraine, we do think that growth is likely to recover in the second half of this year, driven by an acceleration in China and driven by a moderation in inflationary forces. So it's not just the good work that the Fed's first 75 basis points hike has imparted, or the ECB's 50 basis point hike, but more importantly, the top right-hand chart there shows global supply constraint pressure index, and that's coming off quite nicely. It's off its highs, its COVID highs, off its war highs, and that certainly will allow a moderation of inflationary forces, which at least over the next 12 months will give central banks some idea of not having to raise further than they expected, or surprise the markets to the upside. At the same time, markets have fallen quite low. In fact, it's quite amazing because markets, it's not only equity markets have fallen, but because quantitative easing, the unwind of QE, has caused bond markets, and inflation rising, has caused bond markets to sell off. The sell-off that we've seen in the first half of 2022 amounts to $40 trillion globally. So $40 trillion have been wiped out of wealth by falling bond markets and falling equity markets. Now, that's the biggest destruction of global wealth over the last 20 years, bigger than the great financial crisis of 2008, bigger than the pandemic of 2020, and a phenomenal amount. Yes, its nominal terms hasn't been adjusted for inflation, so it's probably worse than it's not as bad as it sounds, but it does mean that a lot of risk is priced in, and certainly the wealth impact that it'll have will see a decrease in demand, which should see inflation pressures come off. So that will again allow central banks not to have to push inflation interest rates up too high. So that said, we do remain overweight equities. We think that it's appropriate to have a small overweight in equities, but we do keep it in defensive equities as opposed to in cash or bonds. We think that global bonds will still see some headwind because of rising inflation and rising interest rates over the next few years. And QE is still going to distort gold and global bonds. But more importantly, our favorite defensive position has been dollar cash, and dollar cash is looking incredibly expensive. Bottom right-hand chart shows the broad real effective exchange rate is close to its 2002 highs. And you saw the last time I got close to these levels, the dollar weakened for the next decade. So while I'm not calling the top of the dollar, because the dollar is very momentum driven, it's definitely getting closer to the one end than we are to the other end. So we are also looking at diversifying our dollar cash holdings into other cash. Yes, Europe has its problems in terms of the war. Japan has its problems in terms of not allowing its interest rates to rise. The UK has its problems with sorting out what's going to happen since Boris has resigned, and Brexit has been an unmitigated disaster for the UK. But the dollar is just looking so stretched that we're starting to diversify out of that asset class. Okay, great. So that is the market outlook. No changes here. We still overweight, small overweight to FTSE, large overweight to China and healthcare and value, and overall overweight global equities. So now let me get into the 4Ds. And it's all about how to invest in turbulent times. Now, this is a view we've had for many, many years at Sygnia. And we think that what we're seeing now in the markets, all this volatility, is just symptoms of something that's been in place for over the last decade, and that's low growth. When debt is high and growth is low, any wobbles become magnified. And so, in the same time, when growth is low, people start fighting over a shrinking pie. When growth is strong, there's profits to go everywhere, and there's no concerns. But when growth is low, people start fighting over a shrinking pie, and then you get protectionism, and you get a lot of inward focus, nationalism. You get things like Brexit and wars, and Trump's trade wars, and all the crises we had over the last decade are pretty much symptoms of low growth. And we think that that's only going to get worse. So low growth is caused by a number of things. It's caused by debt, and debt is still now at an even higher, or it's reached a new all-time high, as shown by the chart on the right there from JP Morgan. Yes, as a percentage of GDP, it's a little bit off its peak, but in nominal terms, it's over $300 trillion at an all-time high. Now, why is debt bad for growth? Well, first, it increases volatility, because when you're highly leveraged, highly geared, any impact that you have has a magnified impact on the bottom line. More importantly, high debt means that your interest payments are much higher, and particularly in an environment where interest rates are rising, when you've got a peak debt levels and now interest rate rising, it means that your interest payments are at a new all-time high. And that just takes money away from profits, it takes money away from research and development, and generally leads to slow growth now and slow growth in the future. The other headwind that we've been seeing for the last decade is demographics. That is a direct impact on potential supply side GDP growth. So GDP growth is made up of two things: productivity and number of people working, and the number of hours those people work. So when you have aging populations, more people retiring than people coming into the population working pool, well, then you've got shrinking supply side growth. So that means that your GDP can no longer grow with productivity plus labor, it just grows at productivity. And in some cases, like Japan, where that labor supply is shrinking, you need positive productivity just to keep GDP at zero. We've now got, and those demographic headwinds have spread across the world. Japan started with aging populations 15 years ago. Europe moved into that spot 10 years ago. China was there 5 years ago. The US is going to hit that in the next 5 years. So that's something that's getting worse and worse and worse across the world. So increasing headwinds from debt, increasing headwinds from demographics, new headwinds from decarbonisation. It's a whole new headwind where companies have to start, and rightly so, start pricing in the indirect costs on the environment that they've never had to worry about before, such as mining companies rehabilitating the environment, or carbon taxes, whatever it may be. That is going to be a tax, and it's going to be here for a while. Moving energy sources from dirty energy to clean energy, and that is certainly a headwind to profits and a headwind to growth. And then a relatively new one over the last 2 years, a headwind for profits and headwind for growth, is deglobalisation. So deglobalisation first came about in the late 2018, 2019 with Trump's trade wars. where there were tariffs put in place in China, and some of the American companies were forced to look at alternative sources. But you can see on the chart on the left there, that didn't have a major impact on deglobalisation. What happened was COVID hit, and that was the first direct hit to supply side, and companies started worrying about supply side security. So there they said, well, let's not only is it possibly a good idea to bring back supply to onshore supply because of the fact that it creates local jobs, and there was this national push because of low growth, but it's now also very important to have supply side security because COVID is disrupting supply chains. And as we started to roll out of that concern, you can see the chart flips down. Then we had the war, and again, supply side disruptions due to the Russia-Ukraine war. And once again, corporate talk of deglobalisation, in fact, it reached a new high. So corporates are now, because of COVID, because of nationalization, because of job creation locally, because of the war, they're now focusing on supply chain security. And that means that it's not about the most efficient and lowest cost supply chain. It's about having a supply chain that is more robust. It can handle COVID supply disruptions. It can handle war supply disruptions. It can handle tariffs and trade wars. And that will all come, unfortunately, at a cost. Yes, your supply chains may be more robust, but your profit margins certainly aren't. So again, that's another headwind to growth. So all of that, so it's a long story to get where we want to be, but all of that saying is that growth is going to continue to be low over the next decade, possibly even lower than it has been. And volatility is going to remain high. So when it comes to investing, we need to find places that are going to still grow in the next decade. So themes, sectors, companies, doesn't matter how you look at it, but you want to find companies that will still grow margins and still grow market share over the next decade. And we do that through thematic investing. So we look for groups of companies, themes, that will still be able to grow margins and revenue over the next decade, despite lower growth. So you're all well aware of our satellites, so I'm not going to talk too much about them, but the first one is disruptive technology, our fourth IR fund, and that's all about creating new markets. So yes, while the market for coal-powered stations might be dwindling, the market for EVs and solar panels and the metaverse, those are all new markets that have been created. So even though as the world growth is slowing, those actual markets will grow faster than the economy, and so it's a good place to hide. The other one we like is healthcare, and that's because aging demographics means that as people are getting older, that pool of consumers is growing, and so even though growth is slowing, there'll be a strong push as more consumers come into that space, which will drive healthcare spending, not to mention all the innovations we see in that area, which will also lead to better margins and increased spending. Third one is emerging markets, but China in particular, but emerging Asia in particular. We see that emerging Asia is going to drive the next billion middle class consumers, and as those billion people move up the LSM, they will start buying more TVs and more microwaves, and again, those geographic areas will see increased growth despite the fact we're in a low head. So you're all well aware of our long-term thematic themes. That's where we believe you can hide. But I am going to talk about some specific ones. Just 3 slides, 3 specific things we'll do even better because of COVID and because of the Russia-Ukraine war. So it's the existing themes that we've liked. We think those themes are going to be accelerated by the states of disaster that we're seeing in COVID and the states of disaster that we're seeing with the Russia-Ukraine war. So looking firstly at COVID, the COVID states of disaster around the world has led to massive increase in government spending in healthcare. Biden has just put forward a request for 22, and this is now in March of this year, April, extra $22 billion into COVID research. And that will filter straight through into broad healthcare, but in particular, it will feed through into the genetic revolution. And the Sygnia Health Innovation Fund has an allocation to genomics and genetic engineering, and we have just topped up that exposure because we think that prices have fallen and the outlook for the sector is looking incredibly exciting. Why? Well, the research into vaccines directly impacts research into genetic engineering. So the previous fastest developed vaccine was mumps in the 1960s. It took 4 years to develop. The COVID vaccines, the first COVID vaccines, took less than a year to develop. It was 5 times faster, and that was enabled through mRNA or messenger RNA. And mRNA is all about, it uses the CRISPR-Cas9 protein, which allows the very easy and simple editing of cells' genomes. And so the vaccine was created by editing the genome and the cells of the vaccine and creating the vaccine using that technology. But that technology is the basis for genetic engineering. So already before that even happened, we've seen the top right hand chart there. You can see the cost of the human genome, to sequence the human genome, has plummeted faster than Moore's law. First time we sequenced the human genome was 2003 at a cost of $150 million. That's expected to drop to less than $100 by 2026, and it's leading to a massive drive for personalized medicine that is matched to our own DNA. And in 2019, already we saw personalized medicines accounting for a quarter of new FDA approvals in the US. But mRNA and the CRISPR-Cas9 protein, which was discovered in 2012, that is going to lead to a massive changes in the way that medicine is distributed, the way that medicine is created, the way medicine is used. And that protein is the future of healthcare, what the transistor was the future of the iPhone. Genetics is going to be democratized. Digital coding is going to be replaced by genetic coding. Yes, it might be 60 years in the future, but that's the future that we're heading towards. I mean, already in your kitchen, you can buy a home kit for less than $200 that will allow you to edit the genome of yeast and splice in a jellyfish genome to make that yeast glow. That's how simple it is to do that. It's quite scary because obviously there are a lot of ethical issues, but that's how simple it is that you can with using this CRISPR-Cas9 protein mRNA in your kitchen, you can genetically engineer yeast to grow. Anyway, we think it's a very exciting place to be, and that's why we have increased the weight within our Health Innovation Fund to have a high allocation to the genetic revolution. The other thing that we're excited about is renewable energy, and here we've got two ways that we are increasing our exposure. And here the acceleration in renewables is as a result of the Russia-Ukraine war. So there is already going to be an acceleration in renewable energy that was being expected, but the Russia-Ukraine war was going to see a demand for energy security in Europe in particular. So coal plants and gas plants aren't green. It's unlikely they're going to build new ones. Yes, in the short term they are firing up old ones, but the only solution really to energy security is renewables, and I'll talk about that in the next slide. Renewables, nuclear, and fusion. And fusion is what this slide is all about, and it's incredibly exciting. So the Sygnia Oxford Sciences Enterprises Fund has a decent exposure to first light fusion. There are some exciting things happening at that company. And we did a site visit in February of this year. It was shortly around the time that the UK Energy Authority validated their projectile fusion. They're the first company in the world to have successfully do projectile fusion, which is incredibly exciting. So let me step back a bit. I get a bit excited about all this exciting opportunities. So fusion, what is fusion? Well, the first fusion bomb was created in 1952. The thermonuclear weapon, it is vastly more powerful than fission or the nuclear bomb that we are thought of in World War II. So fusion is vastly more powerful than fission or nuclear fission, but the problem is you need to ignite it. Fusion just can't spontaneously happen. It needs a very powerful ignition. So the bomb in 1952 it was still dirty. It used a nuclear explosion, a fission explosion, to catalyze or ignite the fusion explosion. And clean fusion is all about finding different ways of replacing that dirty nuclear fission, different ways of achieving ignition of the fusion reaction. So up till now, and the joke has always been with fusion from the 1970s when they started to look into it, that fusion, how far away is fusion? 30 years, or it's always 30 years away, and it has been until now, where we've got validated proof of projectile fusion. So fusion up until now was inertial fusion. That means that they had a room, there was a target that they wanted to cause, or they wanted to ignite, and the room was filled. You can imagine the complexity of this, filled with intensely high-powered lasers, which try to create ignition around that point. But a lot of tricky dynamics around that. Projectile fusion is much simpler, and it's about shooting a projectile at that target, and the explosion that happens on impact ignites the fusion reaction, and we've now achieved that. And it was driven by what the beauty of this, it was driven by nature. So yes, humans are creative, but we got to the skies by looking at birds, and a lot of our ingenuity is by looking at what happens in nature. And once again, this was driven by the pistol shrimp, which claps its claws and at the same time generates heat in excess of 5,000 degrees centigrade, which is close to the heat on the surface of the sun. So that natural beauty is what led to this creation. Anyway, projectile fusion is 4 times more energy efficient than inertial fission. It's more scalable, it's cleaner, and they have now, having validated what their technique, they are going to be building a plant, and they're going to be doing a capital raise to fund that new plant, and we think that there are very exciting times ahead of that. So that is in the Sygnia Oxford Sciences Enterprises Fund. There is some capacity available, so if you want to get involved in that private equity fund, then please do. The third component that we're very excited about, and again is going to receive an accelerated boost, is our Sygnia Sustainable Economy Fund that should be launched within a month. So it's an ETF, it's an ITREX fund, and that focuses very much on renewable energy. So you can see that the chart on the right, which even before the war showed that renewable energy was supposed to increase by 50% over the next 5 years, and account for up to 40% of global electricity production. That is now going to see an acceleration, and so we're very excited about that. And that's going to see even further increase, because of the Russia-Ukraine war. And this fund invests in not only renewable infrastructure like solar panels and electric vehicles, but in particular some of the surrounding architecture. So it's smart grids, smart buildings, smart homes, infrastructure supporting autonomous vehicles. So it's electric vehicle charging points, it's hydrogen stations, commercial drone deliveries, AI traffic routing. In particular, one of the examples I've got here is Plug Power, and they look at the entire hydrogen architecture, and that is from creating hydrogen, to storing hydrogen, to moving hydrogen around, and to integrating hydrogen into different vehicles. And already we've seen Anglo American have a world first, launching the biggest, using some of the biggest mining trucks in the world and converting them into hydrogen vehicles. Toyota has got a range of vehicles in California that are hydrogen driven, and there are some exciting opportunities there. These are still EVs, so a hydrogen vehicle is still electric, but it is purely green. It has much better efficiency and much larger range, and there are a lot more reasons why it is better, particularly for heavy vehicles, but also small vehicles compared to just standard batteries. Yeah, so a lot of exciting things happening there, but I see we're short on time, so I'm going to not talk too much about that. We will go into more details on all the sectors of this fund in particular when we do the launch in a month's time. But more importantly, there are places to hide in a low growth world. So despite an acceleration in the 4Ds, thematic investing is a place you can hide. I don't think gold is certainly not something that I believe in. I think that gold is currently distorted by quantitative easing. It's double the price of its purchasing power. Global bonds are certainly still distorted, and interest rates are going to rise. So defensive thematic investing in areas that are going to grow over the next decade, such as the emerging market, middle class, health, innovation, disruptable technology or innovation stocks, all very exciting. And in the short term, we see an acceleration of some of those, in particular driven by COVID in terms of genomics and renewable energy and fusion in terms of the Russia-Ukraine war, which will lead to acceleration in renewables. So some exciting things happening and some exciting places to hide despite all that's going on in the world. So that is a wrap on that. So let me get to the Q&A. Okay, question, Box van Tunda asks, going forward, which Sygnia funds do you see value in? I'd have to say that we see value in our thematic satellites, and you can look at which ones we prefer the most, by which is the highest overweight. So we do have our largest overweight in China, the second largest overweight is in healthcare, third largest is value, and the fourth largest is 4th-IR. So I suppose looking at the relative sizes of our thematic positioning shows where we see value. But it all depends on how much risk you want to take. South African bonds also looking incredibly attractive if you want something more with a lower volatility. There are certainly some good places to be overweight, and certainly we are overweight in a number of those. Rene asks when the adjusted values are going to be released in September. I think it's the 29th of September that the adjusted US or the revised second quarter US GDP comes out. And so we're going to be looking closely for that to come out. And he follows on with a question on earnings. So while we are bullish on the world, and we certainly are bullish on our thematic themes, we are still quite concerned about the US. From a concentration perspective, and the US is 70% of the MSCI world, and we don't like being that concentrated, but also there are certainly some headwinds coming to the US. The US margins are the highest level they've been in 60 years, which means that the profits, the share of profits between labor and capital have diverged the highest level in 60 years. And certainly we think that with high inflation, higher wage inflation, there's going to be a move back towards wages share of profits in the US, which is going to impact capital share of profits. So we do think that although revenues will continue to grow nicely in the US, we think there could be some earnings disappointment in the US as margins contract. We're not forecasting anything devastating, but we are underweight the US. We do think that some of the risks lie there. And certainly on the big tech stocks, even though they are fantastic businesses, new antitrust legislation looks like a number of those big companies are going to be unbundled over the next 12 months, and we could see some short-term headwinds there. So yes, headwinds to earnings in US companies are something that we are concerned about. It is why we are underweight US equities. Sean asks if onshoring and supply side security is bad for inflation. It certainly is. Yes, we saw that in the Trump trade wars. Not only was it bad for inflation because of tariffs, but it was bad because you're not using the most efficient way of achieving it. So I think there's two answers to that. One is we're already seeing the Biden administration trying to reduce or remove some of the tariffs between the US and China, which would be deflationary, which is good. And at the same time, although companies are talking about deglobalisation and supply chain security, it is uncertain yet as whether they're prepared to sacrifice profits for supply chain security. So we'll see how that leads. We think that's going to be a big change over the next decade, but we don't think anyone's going to do any knee-jerk reactions and suddenly have an earnings loss just so that they can get security. I think this is just a way that they're going to be planning over the next decade. So if we have to look strategically over the next decade, certainly ESG is a big player, and supply side security or at least supply side innovation or diversification is something that we see will be driving businesses. Sean asked again about nuclear power, and you spot on. So in the short term, we've seen Japan switch on 9 nuclear reactors. We've also in the short term say that from Europe is saying that they're prepared to restart some of their coal-fired power stations. So certainly to avoid energy price crises, or to maintain energy security, we're definitely in the short term seeing nuclear power plants being turned back on and coal power plants being turned back on. So that's definitely something that's going to happen. Going forward, renewables are much cheaper than nuclear, so it's more, and they're much faster to get online. So we definitely do think there'll be more renewables that take place. I don't see, while some nuclear might come online, we certainly don't think it's significant. The big hurdles to renewables are storage, and we seem to be getting some very good developments through that on the hydrogen side and other alternatives. So if you're not worried about size, China's got some fantastic startups that are looking at salt ion batteries, massive batteries, but only using salt. And if you put plants in a salt ion battery close to your renewable power stations, low cost, and could solve a lot of problems. So a lot of exciting technologies out there that could help us through this. Michelle asks about taking money offshore. Do you advise to stay in US markets or into markets? I think when it comes to offshore, you have to worry about 2 things. One is the currency, and the currency certainly we put on a lot of protection when it got above 17. But unfortunately, the currency has retreated nicely and is looking stronger. We have to wait for commodity prices to bounce further before metal prices in particular, before we think the rand strengthens much more than it currently has. So it's a rand outlook in terms of taking money offshore, but it's always good to stagger that. And I very much believe in rand cost averaging, because it's very hard to pick the peaks and troughs of any investment. And then diversification is very important. So we certainly don't think you're putting all your money into one basket. The Sygnia Skeleton International Equity Fund that has a nice variety of benchmarks against MSCI all country world. At the same time, we've got all our thematic themes in that, but we certainly would suggest that you at least diversify across regions and themes globally, and not put everything just into the US. Sean asks about SA being a debt trap. There certainly are risks to South Africa. I think a lot of those risks are priced in. If you look at, I mean, my biggest concern when it comes to buying South African bonds, not so much a debt trap. My biggest concern is that US interest rates rising impacts our bond yields, but I think there's enough margin price there for our bonds to still, our bond yields to strengthen even as US bond yields do go up. So that is certainly a nice margin or buffer. The Sygnia Health Innovation Unit Trust and ETF do pay dividends. So John, that asked your question. So yeah, I'm pretty sure there are dividends coming out of those, both that fund and that unit trust. Certainly probably not as high as the index, because we do have an exposure to, or at least in the unit trust, we've got an exposure to Oxford Sciences Enterprises, and we've got an exposure to genomics, both of which don't pay dividends. But the ETF would pay the same dividends as the index, and the unit trust would pay slightly less dividends than the index. Remember, all your fees and costs come out of your dividend on iTrix, so it does bring you your, and the unit trust, it does bring down your yield slightly. There's a question about why decarbonisation is still seen as a global growth headwind, not a tailwind. That's a very good point. Certainly for certain industries, decarbonisation is definitely a tailwind, and that's why we are invested in 4th IR and other, and why we're launching our new sustainable economy ETF, because there definitely are some industries that decarbonisation is going to be a tailwind forward. But on the whole, all your existing industries are going to have to spend a lot of money to bring themselves in line with either new environmental requirements or energy specifications, all of which will be a headwind. So it means you just got to be selective where you invest, and that's why we in particular are launching this new ETF. Sean asked about the EU. Yeah, Sean, we're still not that excited about the EU. Yes, it is cheap, but there are a lot of risks that could happen in the country, as I have explained. If there's no further deterioration in the war, then possibly we're close to lows, but there could very easily be deterioration and high energy prices, which will further decrease GDP. Kubus asked about the skeleton funds and the exposure to thematic themes. So that all depends on the amount of global equity they have. So that all our balanced funds have exposure to all our balanced funds that have global equity have exposure to our global themes. That varies per fund. So the higher the global equity, the higher the exposure to the theme. And obviously the skeleton balance 70 will have the highest exposure to the theme in the balanced funds. And the skeleton international equity fund of funds will have the highest exposure because it's 100% global equity. Brian asked if we can get a copy of the Zoom. All the presentations are available on our YouTube channel, Brian. So please have a look at the Sygnia YouTube channel. All our webinars, not just mine, but all the ones for product launches as well, are put onto our YouTube channel. So please have a look there. Mervyn asked about our new website. I'm not sure about that. Shane asked, what's the simplest way to access South African bonds? For me, the simplest way is just to buy the Sygnia All Bond Index Fund unit trust that still has 0 fees until the end of the year. So you're getting exposure to the 11% yield on the All Bond Index at 0 fees for the next 5 months now. So that's definitely the simplest way I would suggest, is to buy the Sygnia unit trust. Mervyn asks about the outlook for the Sygnia Divi Fund. Certainly, we do think that the value is something we remain overweight in the short to medium term because of rising inflation and rising interest rates. So we do continue to like the Sygnia Divi Fund. Dave asked a good question about the difference between the 4th R fund and the Sustainable Economy ETF. That we'll go into more detail when we launch that fund. But you can think of the Sustainable Economy Fund as a subset of 4th R. So 4th R has 26 indices. It's got every possible idea. It's got its own exposure to genomics. It's got its own exposure to renewable energy. It's got its own exposure to every possible new technology. But the Sustainable Economy Fund is a subset of that. It focuses specifically on the industrial side. So it's more of an industrial focus than a technology focused, and it's more energy focused. So it's kind of like it's industrial energy subset of the 4th R fund with a specific focus on all the technologies around renewable energy and sustainable economy. Nick asked if there's spare capacity in the Berkshire Hathaway Fund. Nick, I'm sure you've seen the email, but we've increased our capacity for all our endowments and all our living annuities to 45%. That's in line with your retirement annuities, which is 45%. So there's besides that 45% cap for you as an individual, for your LA, for your RA, for your endowment, there's no constraint on Berkshire Hathaway. So Berkshire Hathaway is an open fund, just as Oxford Science Enterprise is an open fund. Provided you are within your 45% across those products, you can buy a Berkshire Hathaway and OSC. Obviously, within the RAs, you do have a certain limited exposure to global equities and single stock global equities and private equities. So you've got other issues to worry about, but there is definitely spare capacity. More importantly, there is no constraint on those funds. Daniel asked about the Chinese stocks and potential delisting in the US. That is certainly a risk. In fact, we think it's a certainty. Already Alibaba is trying to or is setting out to list in Hong Kong. We do think a lot of Chinese companies will move their listings to Hong Kong. That doesn't impact indices, that doesn't impact holdings. It just means that those companies will be held in Hong Kong, so that if there is a delisting, that there aren't any negative consequences. That said, right now China is saying all the right things. They're providing full open disclosure to the US audit requirements. They're supporting DD's relisting in the US. They're approving gaming licenses. So right now, at this point in time, China is certainly very keen to back its platform companies, and to the extent that includes raising capital in the US to improve valuations. We think that's going to stay online. Premier Li and President Xi have all said that employment growth is paramount. And that is linked to their platform companies. They're directly linked employment growth to the internet platform companies. So we think there's a lot more upside to Chinese stocks, Chinese tech stocks. And although there are certainly risks around China, Taiwan is a risk, and delistings in the US, we think that those are low probability events. Obviously, Taiwan is a low probability event with a massive repercussions that happens. US delisting is a low probability event with a minor impact if everybody has a secondary listing or primary listing in Hong Kong. Francis asked about our bond funds. He said, listen, over the last 6 months, the Sygnia Enhanced Bond Fund is down 2%, which seems less attractive than you're saying. So over the last 6 months, yes, the bond funds have struggled. They've had a fantastic yield. They've had a yield of 10% odd, but there've also been some capital losses because as yields have risen, so the capital has come down. So your total return has been about positive over the last year, I think about 3%. So you've had a 10% yield and a 7% capital loss, giving you plus 3%. But as those yields rise, so it becomes a better and better and better investment. Now you've got 11% yield and an even higher probability of capital gains. So the fact that yields have weakened means that it is a better investment opportunity. Yes, it's been tough. We weren't expecting markets to price in, we weren't expecting the Russian-Ukraine war, which obviously had impacts on inflation, which has impacts on a weaker rand, which pushed our bond yields weaker. But we think that that just is a better opportunity to buy, especially compared to other bonds around the world. So I think that's what's key. If you look at South African real bond yields compared to Japan, Europe, even other emerging markets, we've got close to the highest real yields in the world, which is certainly very attractive. It's not without risks. That's why it's not as low risk as a money market fund or an income fund. There certainly is volatility risk associated with bond funds. And that's why we say you need to have a 2 to 3 year outlook on your holdings. But right now we are positive ones. Eric asks a good question about the safety of mRNA vaccines. Eric, I think you're spot on. I think there's still a lot of research that needs to happen, a lot of testing that needs to happen. It is still, the mRNA, CRISPR-Cas9 protein has been around for at least over a decade. So there is some certainty on that. But even then, I mean, the long-term impacts of that are unknown. I mean, we had an example where China's Dr. Frankenstein was jailed for successfully editing in the embryos of twins to remove the gene which allows them or puts them at risk to catching HIV, contracting HIV. And that was, on the face of it, quite a successful operation. But no one knows the long-term impacts. And that's why so unless it's a life-threatening disease with no other options, using genetic engineering right now is still restricted heavily because there's a lot of uncertainty. But all that says we're in the very early days of that technology, and even around vaccines, it's early days of that technology, and we'll have to see what happens. But potentials are phenomenally exciting. Paul asked about outlook on global property. Global property, we think is went through a huge amount of COVID issues. A lot of those are rolling over as lockdowns end. Now it's got headwinds from rising interest rates, global property being a proxy for global bonds. So we do have a small allocation just because we don't have any global bonds, but we're not particularly excited about global property. We just have it as a hedge against not having any global bonds. Yeah, Miles, there certainly things could escalate in Russia, and there certainly are a lot of risks there. It's not our base case scenario, but it is possible, even though it's not likely. John, I've answered your question on 4IR versus sustainable economy. Mervyn asks about our offshore allocation. Mervyn, as I said, we increased our offshore allocation to about 35% when the Rand was in the mid-14s. But when the Rand peaked at 14.5, we bought some of that back. We don't think now is a great time to be rushing to 45% global equities. There's still a lot of concerns around the world. Yes, there's trouble everywhere, but we don't see the need to make that jump to 45% just yet. Mark asks the outlook for the Skeleton Global Equity Fund for a living annuity. But Mark, I presume, I mean, a 100% equity fund is quite unusual for a living annuity. I presume you're on the lowest drawdown. I'm not even sure the dividend yield on that fund is enough to achieve the 2.5% drawdown. So I'm quite surprised that is an appropriate fund for that as a standalone. But I'm sure your financial advisor has blends it with other things to make it appropriate for a living annuity. Tom wants to understand how South African bonds could give a 20% return. Well, what would need to happen is that right now you're sitting on an 11% yield. So if yield stayed constant, yield to maturity stayed 11% over the next 12 months, you would earn 11%. But if that yield strengthened down to 10%, well, you'd get a capital gain in addition to the yield, which would get your total return close to high teens. Of course, if yields weaken further, we'll have what we had in the last 12 months, which is 11% yield less some capital gains or losses. But that is not our base case scenario. Stephen says, if you're asking for top 10 holdings, the fact sheets only show manager allocation and not asset allocation. If you email admin@sygnia.co, they will be able to provide you with top 10 holdings. Freya asks why we're not bullish gold. So the answer is certainly gold has some benefits, and it is definitely a nice hedge against World War III, and it is ideally an inflation hedge, but it's only inflation. Unfortunately, it's just been distorted by global bonds and quantitative easing. So global bonds are the alternative safe haven asset, particularly developed market bonds. So when developed market bonds were distorted by QE, that had a negative impact on gold. So what I'm trying to say is that gold, even though the gold should be rising because inflation is going up and it is an inflation hedge, it can actually fall a good 30 to 50% just because of the rising interest rates. So you have this headwind, which is probably going to override the tailwind. Yeah. I'm not sure when the new alchemy platform is going to be launched. Again, if you email admin@sygnia.co.za, they might be able to give you an update. Clement asked when's the right time to buy stocks or equities to take advantage of low current prices. Clement, as I said, it's impossible to call a bottom. We have got a small overweight. If markets fall more, we'll increase our overweight. but if markets run, then at least we are overweight. So I would rand cost average and then start to nibble. And that's it for the questions. It's fantastic. 12:15, 75 minutes, which is exactly what we put in for our CPD requirements. So hopefully it's enough to get a full point. We'll see how that goes. Thanks everybody for dialing in. Thank you for all the questions, and I'll see you all next month.